Hello, and thanks for joining us today. Look, making money in business means nothing if you don't actually use that money wisely to then continue to make a lot more money for you. And actually, it's interesting because this is something I just came into the realization of is that, if you want to be a billionaire, for example, it doesn't have to be that you build a billion-dollar business. What you can do is build a very successful business, even exit that business, and then use the money you're making along the way, even with the exit. And if you're investing it right, then you can actually use the money that you're making and have made from the business to reach whatever status you want to make $1 billion or more. But in order to do this, you have to be able to understand investing. You have to be able to do this smartly. And to help you do so today, I brought on two very special guests. First with us is Julio Cacho. Now, he's the founder and chief investment officer of Quantor Capital, as well as the CIO of Inscription Capital, where he provides highly personalized advice to family offices, financial advisors, bankers, asset managers, institutions, and wealthy individuals on their investment portfolios and financial products, and oversees more than $1 billion in assets. That's a lot. And also is Juan Carlos. So Juan Carlos is the founding partner of Quantor Capital and managing director of Inscription Capital. After graduating from the University of Texas in Austin, he began his financial career in Madrid, Spain, working for a boutique consulting firm. Guys, thanks for joining us today.
Thanks for having us.
Well, I'm really glad you guys could be here because this, like I said, this is a huge realization for me recently that I don't have to build a $1 billion business to be a billionaire. If I want to be a billionaire, right? I can actually build a $50 million, $100 million business and exit. But what I can do with investing that money is where I can then reach a whole higher level than running a business. And so I really am glad you guys are going to be here because I'm hoping you guys can give us some guidance on the right way to invest to get the best returns because we don't know much about this stuff.
Yeah, no, that's a great point. I think a lot of times, especially, entrepreneurs don't realize the risks involved of starting a business, right? And so, we hear about the winners all the time. What we don't hear about is all the people that have started businesses that have not been successful in the long run. And I think it goes to show how we can maybe approach it from a balancing act too, that if you do have a business that's succeeding and you're growing it well, to start thinking about, how do I start diversifying a little bit to where I can also start growing wealth side by side with my business for the long term. Especially if you sell your business, then you really need to think about it. But yeah, I think it's a very important topic, and I'd love to get into it more. With
yeah,
you.
and it's interesting because it's important, like you said, on both sides. I mean, realistically, we all build a business, a lot of us to exit, and very few of us do. I mean, the vast majority of us, very, very small percentage of businesses ever successfully sell. So if your business doesn't sell, like you said, you have to be diversified. You have to be making money with smart decisions on investing. And if your business does sell, well, then you got to make decisions. So this is really relative on both sides of them. But let me ask you the bad side of this. Where do people mess up? Why do most people fail with investing and they don't have the money that they need in retirement to be able to carry them through?
So I think it's because many people don't understand the facts. There are many misinformation probably about investing. And there are a few mistakes that people can make if they don't know about the facts. For example, two main facts in investing are, first, that expected return and risk are related. What this means is that if you don't want to take risk, then you shouldn't expect high returns. In contrast, if you want high expected returns, then you need to take a lot of risk. Now, talking about entrepreneurs, one characteristic that entrepreneurs have is that they are risk takers. They probably can tolerate more volatility than other people. So that's why, on average, you expect to see high returns with entrepreneurs because they're taking more risk. What this means is that actually it's extremely difficult to find free lunch in the markets. It's extremely, extremely difficult to find them. It's so unlikely that it's better to think in terms of risk and the amount of risk that you are taking than trying to find these free lunches out there. The second fact is that most investors underperform the market. What that means is that if you take a long period of time, you will see that most investors risk adjusting the returns are lower than what a given market pays you. So what I mean by that is, let's suppose that there's an entrepreneur that wants to start a pizza business, wants to sell pizzas. The market of this person is not only his business, but there are other businesses similar to the pizza, which could be McDonald's, for example, or Domino's Pizza, or many other fast food restaurants. The market of this entrepreneur are all these restaurants. The question is, can the entrepreneur outperform all those other businesses adjusted by risk or not? And what we see in the facts is that most investors do not outperform that market. Now, given these facts, many people are not aware of this, and then they will try to outperform a market. They will try to take risks sometimes that you don't get compensated for taking those, and they pay a lot of costs in the way. So costs is a very important, or fees are a very important, I would say, component in the mistakes that people make by not taking a deeper look into those. And there are other cognitive biases that people make. Some mistakes that some people make because of we as humans, we can make some systematic mistakes. And one of those could be that we don't actually look at the statistics. We overview sometimes the statistics, and we follow more our intuition than the true actual data. That will be another mistake. So there are many, but these are some of the ones that I wanted to summarize.
You know, and I appreciate that, because it seems like what you're touching upon is a big problem I see, is that who do you take advice from? Like, Julio, I mean, that's the problem, is it seems like there's so many people out there in the investment space in different aspects of it, and everybody raises their hand and says they have a unique solution that's different from everybody else. And those of us like me, I don't know. Like, I don't want to have to go through and figure it all out. So how can we figure out who are the best people to take advice from?
I'll answer that real quick too, because I was in the same boat. And you know, Julio obviously has dealt with this a lot more than I have. Julio has a PhD from Princeton University, wrote a thesis paper on portfolio optimization, has, you know, his whole life he's been studying this, but that's what he does. Maybe he's not an expert at engineering, he's not an expert at other things, right? But he is an expert at this because that's all he does. And so I think with all the noise in the media, in the financial media, especially with everyone out there, the problem is we're not getting good advice because we're not seeing the facts. We're not seeing the data. And the data at the end of the day doesn't lie. Like, the data is the data, right? You can massage it, you can twist it, you can spin it, but the peer-reviewed system of empirical evidence that's published in academic journals is so boring to read, but at the same time, it's the best system we have. It's not perfect, right? That goes for medicine, that goes for economics, finance, but it's the best system we have because you have to really have a hypothesis. You know, it's a scientific method at the end of the day, right? It's like if someone has a hypothesis, they test the hypothesis, and then if the hypothesis is proven correctly, it gets published. But not only does it get published, other professional doctors and whatnot have to approve it, and then it gets published, right? It gets like submitted for publishing to a journal. And then in these journals is what everyone's reading in all these scientific fields to try to figure out what is true or what seems to be true or not, right? And I think that is where I think society in general is kind of gravitating towards where I just want to know quickly what's right, or I just want to know. And unfortunately, the right answer is not that obvious sometimes, and the devil's in the details, right? And I think that's where you can, you're not going to go and read an academic journal yourself, but someone like a Julio, right, has, and maybe he can interpret them, right, and say like, hey, how do I digest this in an easier way, right? Because the conflicts of interest exists everywhere where you have, the financial media. I'll use this example. How many times have we heard CNBC or someone on the financial media say that XYZ stock's going to go up or the market's going to crash or whatever? Step back for a second and ask yourself this question. If someone actually really knew what was going to happen in the markets, do you really think that they would be announcing it and screaming it from the top of their lungs on TV? And the answer to that is, of course, no, because the markets are very competitive. If I know that a stock is going to go up tomorrow, I wouldn't tell a soul. I would leverage my house and I would put every last cent I have in it and keep my mouth shut, because I know that the moment that information gets out there, right, everyone else will do the same thing. So it's counterintuitive to listen to quote unquote experts that have a supposed crystal ball of what's going to happen in the future, because at the end, no one knows what's going to happen in the future. No one has a crystal ball. The best thing you can do is see, what are the risks that I'm taking? How do I prepare for those risks in a thoughtful and mechanical way? And then do that accordingly.
Yeah, and that makes a lot of sense, because when you talk about, I like the idea, especially of talking to somebody that has that knowledge, because I'm going to look at it. I'm not going to, like, it's not mind numbing, and that's what's crazy about entrepreneurs. I don't know what the deal is, and I've talked to enough to learn that it's not just me. Like when it comes to attorneys and accountants and like that micro level of thought, it's like nails on a chalkboard. A lot of us, Phil, you know what I'm saying? So like, we need to talk to somebody that knows what's going on. So I appreciate you kind of giving insight of exactly how to do that. What kind of theories out there are the main theories of investing that you see, and what kind of ones do you think work best?
So we think that, as Juan Carlos was saying, the scientific method is the best method that we as humans have developed, actually, and it's applied to every single field, from medicine, physics, chemistry, and you can apply this also to investments. And it's just a methodology, right? Which is you based your investments on facts. You have a hypothesis that has been tested over and over, and then that's what you use as your main framework. In concrete, if I want to give an example in concrete, given, for example, the fact that I was telling you that most people do not outperform risk-adjusted the market, then Fama actually in 2010 in a paper, Dr. Fama is a Nobel Prize winner in economics. He estimates that 97% of the fund managers do not outperform the market, 97% in the long run, like in 30 years. So what this means is that if you want to outperform most of the people, then the best thing to do is to replicate the markets, the performance of the market. And what that means is try to invest in every single asset in the world, well diversified, very well diversified across all the countries, across all the assets. And that's the only true free lunch. So now you're going to ask me, so how a person can do this? It's relatively simple in the sense that nowadays we have many instruments in the market that allows you to have exposure to the largest companies in the world, to almost all the countries in the world, all the commodities in the world, and you can do that in a very cheap way, very low cost way. You can diversify very, very well. Now, some people, especially entrepreneurs, will say, yes, that's okay. I buy the idea that it's better to be well diversified, but the risk is going to be very low. And that implies that my expected returns are going to be low. What if I want higher expected returns because I tolerate risk? Then actually they can access higher expected returns by, for example, using leverage. Many people invest in real estate because they like the high returns, because they can lever up. They can use mortgages, for example. They can borrow money and invest in real estate. And as long the appreciation from the asset is higher than the cost, then they will have a higher expected return, but also more risk. Remember, risk and return go hand by hand. So the way we advise people is, don't try to outperform the market. Replicate the market. Just replicate the market. Try to do that in a very low cost, using index funds, for example. And if you want higher returns, you can either invest more in riskier assets like stocks, or you can use leverage. Those are the main suggestions that we have for people. I don't know, Juan Carlos, if you want to add something here.
No, that's the main takeaway, right? The conclusions of most of the science-based, academic papers and journals that we've seen in the past 60 years have been pretty consistent in repeating the same message over and over again, because they've done these studies thousands of times where they try to compare active managers versus the market. And time again, we see in the evidence that that the market outperforms the vast majority of them, right? So the vast majority of them fail. Now, the ones that do outperform in one period of time, right? When we see the same observation done in a different period of time, it's about the same percentage that don't outperform, right? The ones that do outperform, but they're not the same ones. They're consistent. They're different, right? So if you've got like 90% of people that fail to outperform the market and 10% that outperform the market in one period of time, call it 5-10 years, and then you analyze it in another 10-year period, you're going to get the same result, about 10%, right? Outperform, but they're completely different people. They're completely different managers. So there's no persistence. So what this also tells us is that looking at a manager or a fund investment's past performance doesn't mean anything, because we have no way of knowing whether that will be persistent in the future. And we don't know. And what's even worse, it's also been documented very well in the empirical evidence that now that we do know who are the 10% that have outperformed, right? Because we see them and we honor them in CNBC, and they're all over the place, and they're the famous people that we all hear about. There's no way of knowing which ones were because of luck and which ones were because of skill. There's no way to disentangle the two, right? Some people might have just gotten lucky. They might have just tossed, heads 8 out of 10 times, right? And some people might have incredible skill. The problem is we don't know how to separate the two, right? And so when we see a past performance, there's always that phrase at the bottom of every mutual fund or every hedge fund that says past performance is not indicative of future results. And that's because it's true. And yet the problem is that most investors, it's the first thing we look at. It's the first thing we want to invest in. Oh my gosh, this person's got an amazing performance track record. I will put all my money with them. But we don't stop and ask, is that the right investment method? Is that the right way to approach it?
It makes perfect sense to me. What about leverage? Talk to me an example. Give me a deeper dive into the leverage, because we've talked about that a few times, but I might not understand it at the level of you do, and what could be done to create leverage to get bigger returns.
Yeah, leverage is very simple in the sense that it's just borrowing. It's just debt, right? At the end of the day, it's just using debt to increase your risk return profile. And Julio gave the example of real estate, which is the most common form of leverage, a mortgage, right? A mortgage is if you have a house that's worth $1 million and you put a $100,000 down payment on it, well, you have a 10% equity, that's your cash, right? And the 90% loan on the house you got, that's the leverage, that's the debt, okay? So now let's assume that $1 million house goes up by $100,000 in price. So that $1 million made that house is now 10% worth 10% more, right? It went from $1 million to $1,100,000, right? But you only put $100,000 in it. So the $100,000, if you sold it tomorrow, you would have to pay the bank back, right? The $900,000 you borrowed, but now you would also keep the extra 100,000 that the price went up by. So you made 100% return on your house investment because the market of the underlying asset, the house went up 10%, but your investment went up 100%. Your risk return profile just increased substantially because you're using this leverage, this debt. Now, the same thing happens on the opposite direction, right? If the house goes down by 10% in value, your equity is wiped out, right? So that's where the risk return is clearly seen. And in real estate, what ends up happening is, this is very common, right? Leverage in real estate is very, very common. Mortgages are very common. People that invest in multifamily apartment buildings or commercial properties or warehouses, very rarely you see people invest in these deals that have cash and then just buy it cash because one, interest rates are so low. So it's very cheap to borrow money to put debt on it. And then if the market continues to do well, right, you can make some pretty interesting returns. The returns are not going to be based on the underlying asset. They're going to be based upon how much leverage you put on it, how much debt you put on it. Does that make sense?
Yeah, it makes perfect sense to me. I just don't understand why people like Dave Ramsey exist. Honestly, like it doesn't make sense to me because like what you say makes sense, right? Like if I can borrow money at 5% or whatever do, right? And then I can invest in it 10%, like that logically, I don't even have to be good at math, and I am, but I didn't have to be good at math to know that that's a good call. So like, are they just talking to dumb people that like they're worried are going to get themselves in debt or not get a rate of return? But you know what I'm saying? Like that's the other side, and that doesn't make any logical sense to me. I mean, like,
no, I think, look, at the end of the day, the risk return profile of an individual, I think is something very personal. And I think I mean, we deal with people all the time that have a vast, huge distribution of risk return profiles. Everyone's different, right? Now I will say this, the more you understand an investment and the more you really know about an investment, probably the more risk tolerant you'll become to that investment because you know what's involved. The less you know about an investment and the less you do your research on it and you're invested in something, the less risk tolerant you're going to be because you're uncertain. Like, why is it moving up and down? What's going to happen if this happens, right? For the house example, if you have a house that you bought it with cash, right? And you don't have a mortgage on it, but you're someone who's very risk averse, okay? It's like owning a bond. At the end of the day, it's not a good investment at all, meaning like your opportunity cost is very low. Okay. But maybe some people just can't tolerate the risk. And so that's all they need. Is it the optimal thing to do? No. If you're going to get a spreadsheet to your point, right, and analyze what is the optimal thing to do right now, if interest rates are at 2% and the house market's going up by 5%, well, then the optimal thing would be to get a mortgage, right? And use leverage. But that way it frees up your cash to go put it in the stock market or frees up your cash to go start a business or now with risk comes, right? With increased, risk comes the potential of things not working out. So the guy who bought the house with cash and the market said the housing market goes down 20%, he's still fine. He doesn't need to sell his house or anything, right? The person who's leveraged to the wazoo on the house and the house goes down 20% and now he can't afford to make the interest payments because interest rates reset like in 2008, now we're in a problem. So it goes both ways, I think. And so it just really depends on the individual and how much risk
tolerance. Yeah. That makes sense. What about a good portfolio? Is that difference based on risk tolerance, or do you guys kind of have a perception of what a well-balanced, portfolio should look like?
It completely depends on your risk tolerance, but I would say a good starting point for everyone is to do what Julio mentioned, is to diversify your investments across all major asset classes, own all the stocks, all the bonds, all the corporate bonds, all the commodities, all the REITs. So you can have real estate exposure to own as much as you can. You can access this pretty simply with a Fidelity or Schwab account, right? And it doesn't take that many index funds to create a proxy of the world. There's a lot of them out there and they're very cheap. So try to diversify as much as you can as a starting point. Once you've done that, then you can tilt the portfolio by adding more stocks or less stocks, depending on your risk tolerance. So to give you an idea, a perfectly balanced global portfolio of all the stocks, bonds, and commodities in the world should probably have about a 3% risk premium, meaning like if inflation's 2%, expect to make 3% a year, right? So meaning like you'll net 5, right? So you can expect to make like a 5% a year right now with about maybe a 5% volatility, meaning that's how much it's going to go up and down, and it's going to vary the return distribution in the future. So, okay, it's not very eye-opening, 5% returns. It's not incredible, but you're going to sleep well at night. And so from there, you can decide if you want higher risk, higher return by either tilting to more stocks, and then that'll increase your expected return, but also your expected risk, your volatility will start to increase. Or you can use leverage, like Julio said, by just leaving the portfolio in the exact same way and then piling on debt to it to increase your risk return profile. Or you can lower the risk return profile even more from that 5% by just adding more bonds to it. So it's a good centerpiece. It's a good place to start. And then everyone can decide how much you can tolerate. To go on an extreme, like for example, for most entrepreneurs should be able to tolerate, because that's what they're telling us in starting a business. If they're starting to save, most entrepreneurs, if they're saving for the long term, should be able to tolerate a 100% equity portfolio, because that's going to be, I'll give you an example. If you own, let's say, all the companies on planet Earth, all the publicly traded companies, you can do this by owning about 2 or 3 ETFs. You're going to own about 9,000 companies. You're going to own Amazon, Google, Netflix, Tesla, all the Chinese companies, all the Indian companies, all the Brazilian companies, all of them, right? You're going to own them all in a market cap weighted form. And you're always going to own the best 9,000 companies, meaning as we move along in the future, right? Some will go bankrupt, some will come in and be introduced into the market, and you're always going to own them because this thing rebalances itself every quarter, right? So you're always going to own the best 9,000 companies at any given point in time. Now, can this portfolio go down in price? Sure, it can go down, and we've seen it gone down 40, 50, 60%. But if this portfolio is going to go down 50%, most entrepreneurs are probably not going to have a business, because that means the economy is crashing, things are not looking good, right? Because that means the price of Tesla and Google and Apple is also going down 50%, GE, everything, right? So everything's correlated in the economy, okay? But this will come back, or it should. And if it doesn't, right, if the 9,000 largest companies in the world that are down all of a sudden 50% doesn't come back, well, then we've got bigger problems, I think, in the world. Like we might as well have the zombie apocalypse upon us, right? Now, that doesn't mean that your company as an entrepreneur might come back. You might go bankrupt, right? Because you're just a small part of the entire market, right? So that should give you a better risk return profile going forward, right? You should probably expect to make around 9 to 10% compounded returns, which if you do the math, 9 to 10 compounded over a 25-year period is quite a good chunk of change, right? So, and that's what I'm trying to get to, right? Entrepreneurs, I think, should be able to take more risk in the public investments, systematic, careful risk, right? Because they're already used to taking risk. Julio might argue with me, though. Julio might say that they might be able to take less risk because they're already putting too much risk in their businesses.
Guys, powerful session today. I really appreciate you joining us. Where can everybody go that's watching or listening to be able to learn more and talk to you guys at a deeper level?
So Julio, your Twitter handle is Julio Cacho?
Yes. Yes, Julio is J Cacho Diaz. That's my Twitter handle, or you can look for me as Julio Cacho. You can find me there.
And then I have a podcast called Now Know This as well that people can find me at. We do some cool shows there as well, just kind of explaining a lot of the stuff that we talked about today.
Website too?
No, the website is our company's quantorcapital.com and inscriptioncapital.com.
Okay, cool. All right, guys, thank you very much for joining us today. It's this has been very enlightening, and I love your guys' perspective. It's unlike anything I've heard in the financial space. So thanks for sharing with us today.
Thank you.
Thank you.
So,
Thank you.
If you're listening and watching this is what matters. It doesn't matter how successful your business is or not. If you're not taking money from the business and investing it in a way where you're diversified and you're setting yourself up financially for success, then things don't look good. The majority of businesses don't exit. So what you do during this time matters. One of my friends, for example, ran a business and put all of her extra money into investments, including real estate. And now once that business sold, she sits there and literally just lives off of the returns of that at a very young age in her 30s. So this is what a lot of us could be doing and should be doing, is diversifying the money that we're making outside of our business, properly investing. And then we've got that security no matter what happens with the business. And if the business does exit, we have a windfall, well, that gives us even more to invest. You really can't lose. So to learn more, I'm going to include the Twitter channel. I'm also going to include the podcast link to now know this. You can also go to inscriptioncapital.com. That's inscriptioncapital.com, or quantorcapital.com. And I'll put both those links in the show resources page. Some interesting insights on both of these websites, including kind of a look in if you look into the Inscription Capital, the luck versus skill article. I love that. A lot of details there. So make sure you check out both sites, inscriptioncapital.com and quantorcapital.com, to learn more. And I'll also put the Twitter and then Not Know This podcast link too, so you can listen in and get the best advice on investing. So thanks for tuning in. Make sure you visit both sites. Have a great day.